Our talk of the tape. Should you lean into this record rally, or is it time to take some chips off the table? Let's ask Chris Hyzy, Merrill and Bank of America Private Bank CIO. So what do you think?
I do think it's time to lean in. I know we're close to all-time highs. If not, we touched them today. We look at the trend lines that are going on. Sure, we're going to get some weakness, right? We have to reliquify the Treasury General account. You're going to see some liquidity come out in the market. Those are buying opportunities. If you look out over the next 6 or 7 years, Sarah, and we just kind of pause for a second on the next week or 2 weeks, the greatest capex boom that we are going to witness is yet to come. It's just now beginning. And that touches
about the AI spending?
The AI spending. And that touches more than just one sector.
It feels like it's begun already.
It is.
A lot of spending.
And we've got trillions yet to go. So there's billions that have been deployed in terms of what has been announced. But in terms of actual input into the actual infrastructure, the digital infrastructure space, it's just beginning. Therefore, weakness in financials, industrials, utilities, information technology, those areas are buying opportunities, even though we're at all-time highs.
And not worried about that offsets tariff pressure, potential margin pressure if the companies have to eat that. I mean, we saw in inflation, some of it's getting passed on, but not that much.
No, it's really not. And if it does get passed on, we know it's kind of limited to a certain degree because you have to constantly have that to continue to pass it on. So what we like to say is these are turnstiles in terms of these worries. You go through them, you don't come back the other way. You can't. So once you go through them, and if there's weakness, those are buying opportunities.
So you feel comfortable recommending people lean in after already we've seen a what? More than, I'm trying to look off the lows, almost 30% rally off the lows for the S&P 500. For the NASDAQ, it's been 40% off the lows.
If this business cycle is just going, and we have 6 to 7 years left of a true profit cycle, which is our opinion, you could potentially be looking at another double in the S&P, which is not a lot of heavy lifting, because that matches the return that we've seen in markets over the last 6, 7, 8 decades.
So I get the buying on all of the spending frenzy over AI. The question is return on investment and whether that will match just how much this is costing.
You know, by default, if you have a catalyst as large as the data center build out is to create and match the infrastructure needed for the demand that's there, when you spend billions and ultimately trillions, the ROI compounds on itself and lends itself to a full profit cycle. So if you have generative artificial intelligence hitting at the cost line, it helps margins expand, it creates greater profitability, and then the ROI is there, not just in the public space, but also the private market
And
space.
that extends to sectors like banks, for instance? I mean, they're a little bit weaker on today's earnings. Are you a buyer?
We're buyers of the financial sector. Somebody needs an asset manager, somebody needs an advisor, somebody needs a wealth manager, somebody needs to lend into the space, and then ultimately you kind of put that out.
That's always been the case, but they haven't always been great stocks to hold.
But the lending itself that's going on, given what we talked about for the infrastructure rebuild, it's across the board. And that just also extends itself to the asset management community. Last time I checked, more people are going to need to retire, more people are going to need to actually invest, because let's just say this, if Social Security and retirement isn't there in the case as it is today, in the future, then you're going to need to start to invest a lot early, and we're already seeing that happen.
What does it all mean for valuations? What do you think is fair at this point?
We have this theory that there's an asset-light era going on right now. The more asset-light you are, the less fixed cost you are, particularly to labor. If that's the case, and they have the cash and they have the strong balance sheets, then multiples should stay higher than what we're all used to relative to history. You know, whether that's 18, 19, 20 times, 21 times, whatever. We'll let the market decide that. But multiple sticky at current levels makes sense to us.